How to make money with cryptocurrency. Nowadays, if there's one trend that's gotten incredibly popular without any increase in what it exactly is, the prize must be given to crypto. And where other sudden cash opportunities like this are considered short-lived, unimportant, or just plain not good paying, if the adoption and international trust have to say anything, it's that crypto is here and it's here to stay. So if you want to be one of the people who managed to get into what's probably the greatest economic world since the invention of paper money, then this video is for you. As always, if you like these kind of videos and want to watch more, you're welcome to subscribe and turn on the bell notification so you don't miss any of our videos. And with that done, let's get into it. Now first, some background, starting with the question, what is crypto? If you were to try and find out the single most basic definition of what makes a cryptocurrency, then a cryptocurrency is a way of transferring value in exchange for goods and services without a governing body. And how do they do that, you ask? Well, the answer is a little something called the blockchain. And without going into too much detail, a blockchain is a digital system that records information or transactions that don't need any authority to maintain. Meaning cryptocurrencies are basically value exchanging tools without any large government or bank or fund getting in the way of your financial work. This has understandably made it extremely popular for a number of methods, and those methods and the services required to make them happen have slowly become one of the most popular and potentially game-changing income sources in the world. And so here are 5 of the best ways to make money using cryptocurrencies, starting with number 1. Buying and holding. Probably the most obvious and most well-known method, buying and holding onto cryptocurrency can be one of the most profitable ways to boost up your investment portfolio, given that you know what you're doing. Here's basically what happens. Similar to the majority of stock investments, you, the investor, will research a bunch of currencies, while looking for currencies you feel will blow up, or at least appreciate in their value, with stuff like Bitcoin, Ethereum, etc., being by far the most popular. And after all, it's basically a matter of holding on for dear life until you reach a certain threshold of profit you're willing to sell at. But you ask, how is that any different from regular investing? Well, my friend, the answer lies in the amount of appreciation. Because while stocks are known to creep up slowly and over time, crypto can go up hundreds of times in a period that is less than you can ever expect a healthy stock to. However, that is also where the biggest drawback of this method comes from, which is that where currencies go up fast, they can also go down really fast. Meaning if you're wrong about your investment, you could look at losing more than you originally put in. And so the professional way to go about this would be to be thorough about your research. Invest in a bunch of different places like stocks and bonds, and only keep a specified bit of your portfolio for crypto investments. Because the first and last rule of investment economics is not to put your eggs in one basket. Speaking of investments, what if you're not one to play the long game of waiting to sell? Well, there is another method of traditional investing that has found its way into crypto trading as well. That being number 2, earning crypto dividends. So one of the ways people buy stocks is that instead of letting the stock get higher in value passively, they simply get paid for each increase in value. This method, called dividends, has a bunch of benefits, not the least of which is the fact that since you get the profits in your account, there's basically no risk of losing all the money you earn because of a decrease in value. And although many people don't think that cryptocurrencies have a similar method, there are coins like COSS, CEFF, and NEO that offer you regular dividends just for holding your coin. Now, that's all fine and dandy, but let's face it, investment isn't the only way to earn money, especially not the one most people want to get into at the start. So what else can they do? Well, a very popular thing to do is to help make and maintain the actual blockchain and get paid for doing so. One of the most profitable ways to do this would be to, number 3, run a mining gig. So now this method is a little complicated to understand, so bear with me here. Now, as we mentioned, the blockchain is the publicly recorded and maintained ledger that is basically the backbone of the entire cryptocurrency network. And the way to make it work is that whenever a computer that wants to send money to someone, i.e. make a transaction, they propose a change to the blockchain. And if it's verified, that change of value is recorded on a ton of systems simultaneously. And voila, you just paid someone in crypto. Now here's the bit we didn't mention. how the verification happens. And that's exactly where masternodes come in. You see, in older currencies like Bitcoin, the verification was an automatic process in which it was made so that every recording of a transaction took a long time to take place. And since to fake a transaction, you'd have to make a lot of fake records because the blockchain keeps cross-checking itself, you basically couldn't physically make a false transaction without paying more in computer power than you'd gain. Now, because not every transaction can be recorded from every single person trying to buy something, since that'd take a lot of time, the job of writing that stuff down and running an actual computer to do the processing, you need a third party. And that's basically what miners do. They dedicate their computers to the heavy lifting of writing the blockchain, and for that, they get a reward. Now, although that's certainly popular, it's no longer the #1 passive crypto earning method, since that has been given over to number 4, run a masternode. You see, because of the time and energy it took to do stuff through miners in newer currencies like Ethereum 2.0 and Dash, that verification is instead done by common people called, you guessed it, masternodes. These guys have to stake a bunch of their own money against their transactions, so that if they try to verify falsely, the network confiscates their money instead. And as long as they don't do that, every transaction they verify will add a small amount to their account too. So basically, all you have to do is get your computer to run verification software and have a stake in the currency. And you can earn a very healthy amount of money from that. And last but certainly not least, we have number 5, crypto arbitrage. Now this is one that requires the most skill and experience. However, the potential rewards here are massive. Basically, due to the unregulated and still pretty new nature of the crypto market, the companies and assets there don't really have a history of being accurate on value. So whereas when buying a regular, say, website, you can simply ask a bunch of dealers what the price is in dollars, and I'm sure you'll get the same ballpark amount everywhere. Whereas in crypto, there is generally no consensus, so many times there are very valuable items that can be bought for a lot less just because of being in crypto. As a result, it's possible for someone to look through these assets and find those which he thinks are undervalued and can be sold for higher. And just like that, instant profit. Now those are just a few of the ways you can start to build a cash flow from cryptocurrencies. And there is a lot else out there that hopefully using these tips, you can use to your advantage. And well, on that note, we must end today's video. I hope you found it helpful, enjoyed watching it, and if you did, be sure to leave a like and subscribe for more. With that, take care and I'll see you guys next time.